Please welcome Principal and Chief Commercial Officer for Highgate, Ankur Randev, Chief Commercial Officer of Hotel Asset Management for Starwood Capital Group, Joe Pettigrew, and Managing Director of AB Bernstein, Richard Clarke. In conversation with Skift Senior Research Analyst, Pranavi Agarwal.
Right, yeah, Richard, that was excellent presentation. Very, very good as usual. Fun fact for those in the audience, Richard was actually my former boss when I was at Bernstein.
Former colleague.
Former colleague, okay. And so I'm really going to relish this opportunity to ask the tough questions today, I think. And we also have on stage Joe Pettigrew from Starwood and Ankur Randev from Highgate. And these are really two companies which are leaders in hotel asset management and hotel investment. So it's going to be a really interesting discussion, kind of interesting to hear the thoughts from the kind of asset managers and then combining that with the opinion that's being embedded in Wall Street and in the market. So please do use the app and put your questions in. And if you have any questions kind of on the back of Richard's presentation as well, I'll definitely try to kind of pepper those through the discussion. So Joe, since you're sitting right next to me, perhaps I'll start with you. So we've heard from Richard's kind of presentation that the world isn't ending. You can stay kind of cautiously optimistic in the midst of all the fears that are out there. A looming recession, inflation rates are high, interest rates are going up, a banking sector that's in turmoil, and that has only kind of toughened the finance lending environment that that's already tough to begin with. So kind of trying to break through all that noise, let me ask you a pretty direct question, which is, how many deals have you done in the last 6 to 12 months?
Not many. So I think when you look at, it's interesting, right? Because if you look at the actual hotel operational performance, it's been very strong. The recovery has certainly been real. And in many of the markets where we have the hotels, we've not only exceeded the 2019 levels in nominal terms, but also in real terms, we've been able to outperform that. So the performance of the hotels, no question, they've been fantastic. I think when it comes to sort of the investment and the acquisition sides of things, the things that are making things a little bit more difficult are just the cost of debt, and the valuations are still relatively high, or certainly the ask price and then the bidding price are the spread there is still quite wide. And so when you try to take the yield of your investment versus the cost of debt, and then also the cost of construction, and then the refurbishment and PIP and all of that stuff, a lot of these numbers are not really translating to for at least for somebody like us to have been making big deals yet. But I think one thing that and again I'm kind of on the asset management side where so I'm not really close to the acquisition, but the feedback that I'm getting from my colleagues is everybody's watching this space very carefully. Things are the tap is about to turn on, and when they do, there's going to be a lot of activities, but we're not there yet.
Yeah, I guess kind of last week we saw that the Fed increased interest rates even kind of in the midst of the banking crisis, but they've said that potentially the rate of those rises might, that's a bit confusing, the speed at which they kind of rise will kind of moderate into the second half of this year. So do you kind of expect deal activity, kind of transaction activity to increase or kind of decrease in the next 6 to 12 months? You said you aren't seeing any deals right now, so is the only way up?
Yes. Well, short answer to that I think is yes. The only way to go from here is to go up. I think the other thing to keep in mind is there's going to be a lot of assets that are coming up for their refinancing, coming up, hotels that are now tired, who've been under CapExed, facing pressure from the brands for PIP and renewals, and hotels that are coming off their franchise agreements, and all of that stuff is going to come ahead at the time where you don't know what's going to happen from a lending, and then also again just the cost of construction point of view. So that is definitely going to come to a head, and it will force some activities to happen. Just the timing of those things colliding.
Yeah, I'll come back to the opportunity for kind of distressed assets, because I think that's very interesting. Ankur, from kind of Highgate's perspective, do you agree with what Joe is saying in terms of deal flow? And if you do, I guess, how much longer before it gets worse before it kind of gets better? Or if you don't agree with it, kind of what's your opinion on that?
I think if I start by telling you that I know that, I'll be lying.
Yeah.
So the
Fair
thing
enough.
is, it's a confusing time. I mean, you have, like Joe said, your ground level realities are very robust. Your capital markets are tight, interest rates, you have issues with, which has kind of prompted the entire deal flow to pretty much freeze. We are opportunistic, so we'll continue to kind of look at every deal in its entirety on how our value adds come. I mean, so that there'll be always a place to kind of underwrite assets even now. Mm-hmm. From a perspective of when the shoe drops, nobody knows that. And again, what he was talking about is with loan maturities, fund life issues, so on and so forth, there'll be inevitably some activity that'll happen, and we are kind of looking at those scenarios and how and when that kind of culminates. But overall, I think it is a time there where valuations are tight because of how robust the property performances have been. But at the same time, the focus has to be on the middle of the P&L. You have valuation, concerns where it comes to, interest rates, of course. You have energy issues, you have labor issues, you have insurance issues. I mean, insurance cut capacity entirely. And with the COGS going up, cost of replacement cost is high, and insurable values are high. So all of these aspects are somewhat of a headwind, but you know what, we're kind of monitoring it very carefully. And for now, kind of just, working on the trends.
So let's now kind of connect it to what we're seeing in the markets. And Richard, kind of a lot of the hotel stocks are down kind of mid-single digits in the last week and a half, presumably on the back of the banking crisis. What conversations have you had with investors? Are they concerned? And I think we've heard a little bit about how there's a disconnect between hotel performance and the deal flow, and then there's also a disconnect between the, kind of how the stock market is reacting and how good the kind of overlying performance is. And sorry, long question, but I guess it's a bit of a chicken and egg situation, right? Is it that weak deal flow is what informs weak markets, or is it that it's weak market sentiment that informs kind of weak transaction activity?
Yes.
Sorry.
No, it's fine. Sorry. I mean, you're right. I mean, the chart I showed shows that with the stocks are largely up year to date. They've largely outperformed, and they have come back a bit in the last few weeks. And I think it's just, lingering memories of what the last financial crisis did to the hospitality sector. And I think everyone's looking at it and going, look, if I'm in this scenario whereby we may have, even if it's just a 2% chance of a complete banking crisis, history tells you that lodging is not the place to be. But, history doesn't necessarily repeat itself. And we may, and we've had plenty of speakers today that have said that demand is pretty robust. But I think it is just that fear that this is what happened before. Certainly probably much more on the headline performance, which is good, but fear that it will drop down. And maybe slightly on the construction activity as well. Obviously, post the GFC, we had quite a few years of very limited unit growth. I think we're probably expecting that at an industry level, and it sounds like that's probably what's going to happen. At the branded level, it sounds like a better picture. I mean, Hyatt and Hilton both published record pipelines at Q4, and they're finding some growth somewhere, whether it's from conversions or some more mainstream properties, or with the fact that they're international businesses. But we're not seeing at that level yet that fall down. But I think it's more just that fear that last time the banks collapsed, the hotels had a bad time of it. All aspects of hospitality fell away then.
Yeah, very interesting. I think I want to kind of go back to the thing you said about distressed assets, and I think Starwood CEO has kind of talked about the opportunity of opportunities where assets have broken balance sheets but aren't necessarily broken assets, and that kind of, we potentially might benefit and be a big tailwind for companies like Starwood and Highgate, especially if the banks are kind of out the picture and there are some distressed assets who have come up for refinancing, and you guys could, potentially make a real killing. And I actually want to talk to you, Ankur, about Ace Hotels, which is a kind of small group of boutique lifestyle hotels, which was acquired by a Sortis hospitality firm, which is kind of in private equity. I think Highgate was in conversations with potentially acquiring them, and just for context, Sortis specializes in acquiring kind of distressed assets, and I'm not saying it's necessarily distressed, don't hold me to that, but I think they were potentially not profitable, and Sortis eventually bought them for, I think, 85 million. Can you talk about why you didn't go through with that acquisition? Was it because the ask price was too high, or?
I think...
Sorry, the bid price.
Yeah, so we definitely look at all the opportunities, and again, we are closing on another lifestyle company tomorrow. It's called Viceroy Hotel.
Yes, do you want to talk about that?
Yeah, so I think we looked at the opportunity, and we saw where our value add comes in terms of course, operational efficiencies, procurement, revenue management, and other adjacencies that we can transfer from the wider platform. But for some odd reason, we focused on Viceroy more. So for now, we actually are happy with where we are. So, but again, I wish them all the very best. It's an excellent brand for them to kind of build upon. But there's no good reason that we passed on it and they took it. And it's just that it was something that wasn't a fit for us at that time.
Okay, it's very clear. Since we're talking about Viceroy, I think let's talk about that a little bit. So I think Highgate has about kind of 500 owned and managed properties globally, and you have all these kind of individual properties, but you've never had a full true brand, and the acquisition of a consumer brand like Viceroy is a first for you, which I think is quite interesting, especially the timing of when you've kind of acquired it. Yeah, kind of tell us a little bit more about that. Was it about the brand that you wanted, that attracted you to Viceroy, or was it kind of particular gems in the portfolio, like the particular management contracts that attracted you?
So I think what we loved about the Viceroy, it's got an incredible customer-facing brand. It is an incredible customer-facing brand. It's got a great B2B reputation in the lifestyle space. It's got, of course, some iconic assets, which pretty much largely where the perception is anchored around. We think we have a unique opportunity of kind of scaling this platform where we continue to kind of derive out of the wider platform from the efficiencies part, but lend Viceroy to itself at what they've done really well in terms of branding. We have a good support in-house where it comes to conceptualization, the entire renovation aspects, reimagining. We have a beautiful hotel called the Newberry that kind of shows what we have done in that space. So we just feel that Viceroy is that vehicle that we can definitely grow. At the same time, have the stakeholders, both the guests and the owners, the benefit of the wider platform, which is over 550 odd hotels. So overall, that's the plan for now. And again, we're very excited about it.
Great. Kind of pivoting to kind of talking about investment strategies and kind of the future opportunities. We've heard Jean-Jacques Morin, CFO of Ankur. He said that they have gold in their hands right now, and all you have to do is transform it. And there's this kind of paradigm shift that has happened in the travel landscape. So perhaps I'll ask you, Joe, how has your investment strategy changed in the last 2 to 3 years, and kind of what are you investing in now that you weren't doing pre-COVID?
Well, I think we're paying a lot more focus and attention on really growing into the space where you're trying to differentiate your products and services from the rest of the hotel landscape, right? I think, even before the whole COVID started, I think people were, there were lots of studies, and I think you could see the trends, particularly in the millennials, that travelers prefer to spend more money into experiences and then things, and that actually gives you more happiness than buying things. And I think, throughout this COVID process, what we've seen is not only one, people realizing that, hey, actually, I want to be happier during this, throughout this, and want to invest more into to my happiness. And I think people are kind of coming to that realization. If you look at the actual spend of what the people are doing, have spent over the years, they've spent a lot more on goods, both durable and soft goods, but on services, not as much. So there's a lot of that room to grow for people to spend on services moving forward, and they're going to prefer an experience that is totally different from, what they can get from, your generic hotel type stay, just a bed in whatever destination that you're going to. And so we strongly believe that there is a complete change in people's perception about what a hotel experience is like. They want something that's more experiential, different, and unique. And that is kind of the area that we're definitely be focusing on. We do have, to give as an example, throughout this COVID process, we've learned, our brand, one of our brands, Yotel, has actually found a niche in catering to the remote digital nomads, remote workers. And so if you go to any other Yotels, we didn't really envision this from happening, but you go into the lobby and at 3 o'clock in the afternoon on a Tuesday, it's full of people working in our lobbies and staying for 5, 6, 7 nights, which we didn't envision because those rooms are very small. And trust me, you would not want to spend any more than a couple of days in there. Same thing with our One Hotel brand, which is a eco luxury brand, very focused on sustainability. And people really responded to our mission on wanting to make a difference in the world. Because that is a brand where we translate the idea of sustainability, not with everything that happens under the hood, with the more efficient HVAC and LED screen, but we literally translate that experience physically that you can feel when you're staying there, from a shower timer to stating that all of our rooms are designed with reclaimed woods and recycled products, and all these apples and oranges that actually get thrown away because they're ugly looking and don't make it into the store shelves. We have them in the lobby for people to enjoy. Just things like this, I think people have really responded. And so, and then also, let's not forget a group of people who were apartment or have been displaced away from the multifamily and the apartments in the U.S., finding a space in our extended stay branded hotels in the States. And so all of these hotels that we've got that had found a unique niche and were able to find and were able to keep up with the latest trends are the ones that are completely outpacing the rest of the hotel portfolio that we have that are just perhaps more of a run-of-the-mill hotels.
So yeah, it sounds like a lot of your investments are kind of design-driven, but correct me if I'm wrong, but I think the majority of your portfolio does skew to branded hotels, but if you're kind of trying to implement and find properties where you can go in and kind of put your own twist on the design or the tech, does that mean that you're looking at more independent hotels, which have more leeway in kind of changing, kind of customizing that personalization, the design, the aesthetics, versus a branded hotel, which has kind of more standardized kind of design requirements? Can you talk me to a little bit about that kind of branded, independent kind of skew? And I mean, Richard had a good slide which showed that actually branded market share of pipeline has actually increased. Yeah. So those are kind of at odds with each other. Perhaps you could respond to that.
Yeah, no, we also, like you said, we have a large part of our portfolio is our branded, and we take the similar philosophy that I just talked about just within the brands as well. So I think every investment, we would look at things differently. But for example, we would find the site and try to understand and strategize what is the best fit for that particular asset. And the answer might be that it is a branded hotel, or it may not be. But to give you an example, here in London, we bought 3 former serviced apartment buildings, and we've branded them to a Residence Inn brand. And the primary reason for us to do that was because we saw a void in London, where in the central London, there's not a single select service Marriott brand. And 2, there was no extended stay major branded property in London. And so, when you're identifying a certain site, you could think, where is, we're just very return driven. So it doesn't really matter whether something is independent or branded, for as long as there is a clear differentiated strategy that we can go in to find the gap and fill it.
So Richard, you're quite bullish on kind of the brands, especially the asset-light brands. But kind of speaking about lifestyle hotels, you might see kind of these big conglomerates come in and buying lifestyle brands, but then kind of struggle to keep that innovation and buzz kind of going with that. You potentially kind of brands like W with Marriott or Kimpton with IHG. Kind of how are the big brands kind of responding to kind of stay up to date with lifestyle and luxury and kind of the investments that Starwood and Highgate are investing in?
Yeah, I suppose what they've discovered in many ways is lots of ways to grow that don't necessarily rely on brand development. And I know John Jett said to me earlier, what's important is developing brands. Of course, it's still an incredibly important part of the industry is developing brands. But you look at IHG's recent deal with Iberostar. They've not had to develop a brand there. They're just assisting with distribution. You look at Hyatt's deal with Lindner in Europe. They've found a way to be part of the equation without having to develop brands. So these kind of licensing, soft brands conversions are becoming a bigger slice of it. And then I always think that the luxury position has always been naturally more fragmented. You wouldn't want it any other way. I mean, I think as a consumer, there's way more different ways to differentiate. What you're seeing is in the US is the brands dominate that sort of mid-scale to upper upscale part of the market because people want consistency. That catch-up on a global basis is still huge. Somewhere like China, there's a 15th of the number of mainstream hotels as there are in the US, but there's only 3 times as few luxury hotels. So on a global basis, that sort of, even if you don't believe they can develop great, permanently popular luxury lifestyle brands, they've still got a huge opportunity to grow in that global mainstream position. Yeah,
it's very interesting about how the US is very branded whilst other regions aren't. And Ankur, I think you've done about $1 billion of real estate in Portugal, I think, through Viceroy as well. You're primarily a US-focused company at the moment, but clearly you're expanding into Europe. Is the opportunity in Europe because it's less branded? Is that why you're expanding in Europe? And I guess why Europe over kind of regions like the Middle East? We've had the CEO of Jumeirah talk about Dubai as this kind of burgeoning market. Asia, obviously, the Caribbean. Why Europe?
So again, we were in Europe pre-COVID, and we had successfully exited on 2 occasions. But Portugal specifically, we like because of some great fundamentals around supply and demand. I mean, on the supply side, there is a moat around, acquiring assets. It's got great barriers to entry in a scalable manner. So our scalable entry points, we had that optionality in here. On the demand side, we've seen Portugal quickly become one of the most recognized and popular leisure destination within Europe and now also with Americans. So there's a new demand pattern that we think we can bring here with our pipe in the US. More importantly, I think because of it was less institutional managed, so there's a wider gap on what we can bring in terms of the rate arbitrage here to pick up what the other southern European countries enjoy today, like France and Spain. So there's a gap there. So I think there is an opportunity to kind of fill that rate gap a little bit via segmentation. And then at the same time, we've seen a good amount of talent pool here. So I think all these factors, made Portugal really, really attractive for our growth within Europe. So again, now quickly, with the assets that we acquired, We've become one of the largest, operators in Portugal. So this kind of also creates a beachfront in terms of how we kind of continue to kind of expand our bench strength. And again, so this gives us a good presence in Europe to kind of look at other interesting aspects. We are very, very excited about all 25 top markets in Europe. So overall, we like Europe from the functionality of less brands, more ability to pick up rates and kind of play the segmentational game. And this is where our operational procurement, revenue management strategies come in. We like the idea of deals being extremely complex because that's where we think a competitive advantage is most impactful. So all these factors have kind of really helped us get very good conviction around Portugal for now. But more importantly, this is the way we kind of continue to look at deals in Europe.
Great answer. I guess one of the difficulties in being an investor is kind of navigating the post-COVID landscape and deciphering what are the trends that are going to stay permanent versus the ones that, were just a short-term kind of COVID play. And a key example that kind of comes to mind is vacation rentals, and I'd like to discuss that a little bit. Obviously, companies like Airbnb just boomed, made a real killing during COVID, and the question is whether that strength can stay. Richard, you're very bullish on the vacation rental space. I really like that chart you showed of internet penetration versus vacation rental penetration, especially in emerging markets. But I guess my question to you is, why is it that vacation rentals would be the natural winner as, there is that inherent shift to online? Because if I recall correctly, online penetration in hotels is actually lower than online penetration in vacation rentals in all the regions. So surely as that shift to online occurs, hotels have more of kind of way to go, more of a recovery.
Yeah, I mean, my perspective, I suppose, is that the internet is almost more necessary for vacation rentals. You can't walk up to an apartment in most places. You can't phone them up in most places. And if you can, it's unwieldy. It needs a platform, and maybe in many ways hotels want a platform, but they don't necessarily need one. And you saw, I guess, through COVID that actually the number of people just turning up at hotels spikes, so people are willing to do that. So it kind of needs that online penetration. I suspect there's probably an element of kind of mixing up kind of, correlation and causation here as well. And there's lots of the note that comes from, we talk about some other factors around demographics as well. The sweet spot for vacation rentals tends to be 20 to 40. There's going to be a lot of people in emerging markets joining that age bracket in the next few years, and then rural accessibility as well. I mean, you look at where vacation rentals have their highest market share relative to hotels. It tends to be rural areas away from resort locations, but there's good work done on that shows the accessibility of rural locations is pretty bad in a lot of markets, but it's improving, and that should lead to more second home ownership, which then becomes the growth thing for us. So there's a number of factors on it, but I guess I just don't see anything fundamentally different about where the consumer from an emerging market country is going to be compared to maybe where US consumer is today, given enough time. And therefore, the US is the most mature market. I kind of think most markets will converge towards that position, and that means a massive increase in vacation rental.
I agree, and again, we've seen it, right? So we have about 10,000 units in key markets, which is more urban on the VR space, alternate accommodations. But we've actually seen this entire trend to stay. And again, it's more and more customers on the residential side want hotel-like amenities, and more of the hotel guests want the residential experience. So these things are converging, and we've seen that there is a huge opportunity to kind of pick up on the short and long stay flex and have that pick up on that arbitrage again. So I think this is a very powerful space, and again, Chris kind of alluded to that. Hilton's also kind of looking at it, right? So they're not in it today, but they're looking at it, and Marriott's made a lot of forays, and again, they're ahead on the game on this one. Yeah. But again, it's a very, very solid trend that we continue to kind of observe.
Yeah, I agree. I think branded residences is very exciting. Kind of the non-RevPAR related revenue streams is very exciting. Massive TAM. So yeah, very exciting space. I think we've talked a lot about luxury. So let's talk a little bit about mid-scale. So Joe, Starwood have recently launched a new brand in the US in the premium economy outdoor space called Field and Stream. So people who are not in the US might not really know about that brand. Can you tell us a little bit about Field and Stream and, talk a little bit about kind of balancing that strategy between investing in luxury whilst also into this new space called premium economy, which, we've seen Hilton launch Spark, which is in this premium economy space. I mean, what is that?
Yeah, unfortunately, there's not much I can say about the Field and Dreams as a brand, but the overall strategy is kind of similar to what I've kind of been talking about earlier, right? Which is we need to there is clearly a market where especially if you take kind of that mid-scale and economy market, it's so commoditized. What is the white space of trying to make that more unique and different? And I think that's one of the primary reasons why Spark has been created is that you look at the other sort of branded hotels that are in that space. They're getting old, they're getting tired, but they're cheap, and there is certainly an opportunity to take perhaps hotels that are in a higher category today that are coming out of their franchise agreements or in need of some cash injection, and you can kind of turn that into a more of a premium experience for the similar amount of money that you're going to be paying. And so I think their differentiation is going to be about a refreshed a product and perhaps nicely designed, and perhaps in better locations. I think we're looking at things more from what is the unique selling point, how is that experience going to be differentiated for somebody who's looking for a unique experience at that price range.
Got it. Right, let's end it with AI, because you gotta. Richard, I think you've written a lot about Google being kind of the most disruptive force in kind of the distribution efforts of OTAs like Booking and Expedia. So could AI kind of further that kind of disintermediation of the OTAs going forward, or could it actually aid more direct traffic towards the OTAs? Could that change that kind of distribution landscape?
I mean, the short answer is I don't know. I mean, no one knows really. I mean, we'll see who executes on this best. And I thought what the Booking guy said earlier, where he said, we don't want to just do copycat something that's just a widget. We want to do something that's a bit different. So we'll have to see what these companies come up with. As I said in my presentation, I do think that if you're kind of results agnostic and you're kind of, I think Google's ambition has been to try and make the overall product as useful as possible. And if AI adds to that, then I think it will add to further disruption. And of course, we're going to see Microsoft coming in here as well. And we know that Microsoft partnering with Amadeus, they probably got the access to the most amount of information that's coming out of ChatGPT. I understand as part of their deal, they get all of the uploads from it. So you've got to think Microsoft are going to become a bigger player. How that manifests itself is probably uncertain. Is it going to be Bing? I don't think so, but they'll be doing something in the background as well. So we're bringing big tech into this space, which I think has to be disruptive in some way.
Great. I think we're out of time, but this has been a very interesting discussion. We talked about luxury, mid-scale, AI, branded residences, kind of boutique lifestyle hotels, and thank you so much for joining me on stage today.
Thank you. Thank you.